Section 13(6) in the Tax Act. Yes, this is the dream of most property developers as well as quite a few property investors for rental property in the residential field in South Africa. So let's dig into that a little bit. How does it work? Who qualifies? And what can I do to get in? And what are the pitfalls? So the idea is for people to be long-term investors. Section 13(6) was created during the property crisis of the late 2000s, around about 2009 with a big property crash. And people wanted to, well, get the property market back up. So this is a very interesting piece in the Tax Act that says if you have 5 new or unused properties, you can deduct up to 5% of the property value from tax every year for 20 years. Let's unpack that. What is new or unused? New or unused means that the property is new. I built the property myself with my 2 hands. I am the property developer. Or secondly, if it is unused, it means I am using the property. I am the next person that he sells it to use the property. So I'm not the developer, I buy it directly from the developer, which is quite cool because either way you're not going to pay transfer fees, right? Transfer fees is the thing that kills people. So if it's in your own name, it's going to be registered at the, if you're going to do it, it's going to be registered at the deeds office by the developer, or then the developer is going to put it at the deeds office to get it on his name because he owns the property. So new or unused, 5 properties. It must be residential properties, okay? And with these residential properties, any amount of them can be new or unused, and you can only deduct the 5% for the new or unused of those properties. Okay, so with that in mind, here's an interesting one for you as well. If you are one of those people that actually invest in low-cost housing. If you have any properties that's worth less than 350,000 Rand with a less than 1% rental factor, so that'll be 350,000, 3,500 Rand a month, you can deduct up to 10% of the property value per year for 20 years, which is basically then taking you very much quicker, basically half that time to actually write the money off tax, if depending on what you make and how much tax you're going to pay. Okay, so what's the catch on this? Here's the catch. Clawbacks. If you sell that property within a term of within the term of 20 years, you're going to have to pay back every cent as a form of a clawback. So for example, let's say you deducted 200,000 Rand from tax due to Section 13(6) in the Tax Act, and you sell your property after 10 years, you're going to have to pay back a full amount of 200,000 Rand to the taxman. So how do you get around this? And here's a really cool trick. You can have a company trust structure. Check the link below for the article and the video. So what does that mean? It means you have a trust, and underneath that you have a company, and the company owns the properties. And how that would work is basically then saying, okay, well, the trust owns 99.999% shares, the company then owns the property, and it's the company that's saving on the tax with Section 13(6). If you ever want to sell the company, you can do so, or you can just not sell the trust, but you can basically put that on somebody else's name, and they can pay you a fee for something, and then you basically get rid of the properties and not having to pay clawbacks. So it can make sense. However, new properties are fairly expensive, so you would need to do your calculations to confirm that this actually does make financial sense. Don't forget to subscribe to my YouTube channel, click the little bell to say that you want to receive notifications, and also check out my blog and my newsletter.